Guys, welcome back to the channel. Today I have a very special video for you. I keep getting asked, Valentin, how can I make money without doing any work, without putting in the effort or the hours? Well, I have the perfect solution for you. In this video, I'm going to show you how you can transform $10,000 in $16,000 in just 5 years by investing in the stock market without any experience or knowledge. And I promise you, even your brother, your sister, or your 10-year-old child can do this. It doesn't take any big brains, okay? Now, before we get into the video, I just want to say I am not a licensed investor advisor, and all the equities that I'm going to be showing you in this video are purely for educational purposes. So I don't want to be held accountable for any gains or losses that I might incur. Without further ado, let's get in the video.
Okay, guys, so to get started, I'm going to pretend I'm someone that hasn't done much investing before, or I have limited knowledge in this field. So what you would normally do is go to Google and try to find out what people have invested in before. So let's type in best investment portfolios. And just scroll down here, click on the first one from Forbes, 6 expert investment portfolios you can implement today. So you can take a moment and read the article. I'm just going to quickly go over the portfolios and see if we can find any trends that are similar between them. First one is Warren Buffett 90-10 portfolio. Warren Buffett is a multi-billionaire investor, so he knows a thing or two about investing. What he did is majority of his portfolio is in the S&P 500, and S&P 500 is basically a collection of top 500 stocks in the companies in the US by market capitalization. And some of them you already know, Microsoft, Amazon, Apple, they're all in there. And he only put 10% in bonds. I'm not even sure why he bothered doing this, because bonds, they're fairly stagnant. They don't increase much. They just give you a fixed dividend yield quarterly, semi-annually, or monthly. And that yield is typically like, I don't know, 1% in that range. So it's not a lot. Anyways, let's move on to the next portfolio. We have Paul Merriam, ultimate buy and hold strategy. So this man looks like he's in for the long haul. And he spread thin across all the different types of investments. So he's only got 10% of the S&P 500 versus the 90% from Warren Buffett. And then he just divided in, he picked companies, large cap, small cap, that refers to the company size. So 10% of these different versions. The REITs are real estates, and there's some international companies as well, and emerging markets. Now, beginner would not know what any of this means. They'll just notice that it's 10% broken across a variety of investments. So let's move on to the next portfolio, Ivy League portfolio from the Ivy League universities. What they did is they did 35% in the US equity. So these are actual stock in the companies. 20% bonds, so that's a lot of bonds in their portfolio. Some foreign equity, commodities, it's like oil and gold, and some real estate. So we're seeing again the whole equity part, which was the S&P 500 in the previous ones. It's happening here again, bonds again in this portfolio, and then we're seeing real estate. And I think it was previous in the other one as well. All right, let's keep going here. Coffee house portfolio. Fixed income is again bonds and some of the large cap and small cap companies. So this is again equity, some international, and some real estate once again. And then Bill Bernstein no-brainer portfolio, bonds, European stocks, US stocks, and S&P 500. And you can keep going down and just you're going to notice the exact same trend everywhere. So what are the conclusions? Well, the conclusion is that basically the portfolio should be a balance between bonds and actual equity, which is stocks. And in some cases, some people pick commodities like gold or oil and real estate, but a lot of portfolios can do quite well without these, because these are they can vary quite a bit in performance, and they fluctuate much more than the others. Anyway, so that will be the very first step. Now, what we're going to do is we're going to go through and find out the different kind of stocks we can buy to fill that equity of our portfolio, and then what kind of bonds we can buy, what kind of real estate equities we can get, and what kind of international exposure we can get. And what I've done here is I've just done a little search beforehand to make this easier. I decided to search for best Canadian ETFs in 2020. So instead of buying the actual stocks themselves, I recommend people to go for the exchange traded funds, ETFs. And what these are, they're basically a collection of stocks that are put together. And the reason why they're better to purchase than actual stocks is they have much lower risk, as in when they go up or down, it's very minimal, and they have a very low management expense ratio. So when you purchase a mutual fund, which is like a collection of stocks, they typically ask you for 2, 3, 4, 5% management fee per year, and that's a lot of money. ETFs, they charge you 0.07, 0.1, 0.2, it's nothing. So I recommend for beginners who don't want to experience massive fluctuations in their portfolios, who don't want to lose money, that they go with ETFs. And I'll show you in the end that this portfolio is fail-proof. Essentially, it is zero risk, okay? So I search for best Canadian ETFs 2020 because I live in Canada. You can search for US ETFs, and I'll pick a US one as well. And we can go here and click on the second link here from Wealthsimple. I did a quick scan, so I found some of these ETFs that are decent just ahead of time. So best Canadian ETFs 2020, and you can read through that. We come here in the first table, and I'll just pick the first one for the purpose of this video. So the MER is the management expense ratio I was telling you. See 0.07%. So essentially you're paying nothing to hold this ETF. And the TSX symbol, that's Toronto Stock Exchange, that's where these are being traded, is XUU. So what does that mean? Well, we can actually take this symbol and look up this ETF to see how well it did in terms of performance, what kind of holdings it has, etc. You don't have to do that, but I'll do it just to show you that these are legitimate choices and successful choices. And for market capitalization, what kind of companies that are in here, we got small, mid, and large, so all sorts, so it's perfect. Now, in terms of a good website to verify these ETFs on their performance and whatnot is Yahoo Finance. This is, anybody has access to this, and it's very easy to use. And going back to here, remember the symbol is XUU. So we go to Yahoo Finance, type in XUU, and it comes up right here, iShares Score, S&P 500, US total market. Click on it, and then get a bunch of text. This doesn't mean anything. What I want you to see is the following: yield. This is how much you get by holding this stock, this ETF. I'm not sure how often this is paid. Like I said, it could be monthly, quarterly, or semi-annually. You'll have to find out. But it's 1.34%, which is not bad. It's basically like a bond. And the management expense ratio is 0.07, which is negligible. Now, if you look at the 5-year performance of this, so if you invested $20, sorry, if you bought this January 1st, 2016, it was $20. Today, it's sitting at $35. So it went up by 15. It almost doubled, essentially. And there's some dips here, which usually every single ETF or mutual fund and a lot of stocks will have a similar profile in terms of what happened in March of 2020 and what happened in 2018. These are associated to the market drops. This is due to COVID. This was due to, I believe, tariffs, the US, China tariffs implementation, and high interest rates from the Federal Reserve. So this is a very good graph to see for even a stock, an ETF, or a mutual fund. So going on to holdings, we can see that the sectors that are being represented by this ETF is pretty much divided equally across consumer cyclical, financials, healthcare, technology, industrials. It's really good that the technology sector is represented by the highest percentage because this is the one that drives these ETFs up the most. Okay, and going to performance. 1-year performance, 14% increase, 3-year, 12%, 5-year, 12.5%, year-to-date, 13.9%. really good. You can see in 2019, this made 23%. And as you notice, there's no negative. So this ETF, if you held it since 2015, you'd never lost money. It only went up, okay? Anyways, I'm not gonna do this for every single portfolio, every single ETF, because it's gonna take us a long time, but I just wanted to show you how you can easily check the performance of these, okay? So going back to here, so we have XUU, and in terms of, this was Canadian companies and ETFs that invest in the US companies, which is in the BMO S&P 500 index. This is what we've seen in the previous portfolios. The first one here is ZSP, okay? So again, you can do the same thing. You can go here, search ZSP. Again, I'm just taking the first ones in the list. I'm not doing any analysis. And again, 5-year, boom. It went from 29 to 51 in 5 years. And in performance, look at this, 2013, 40%, 23%, 20%. This is insane. So essentially, if you invested this money, you slept on it, you'd be doubling your money easily. I'm just showing you to people that don't believe that this is possible. And by the way, the stock price is very cheap, $51 per share. It's very cheap and affordable. Most of you can afford that, okay? So now we're done with the Canadian ETFs. Let's move on to international ETFs. And I've searched for best international ETFs 2020, and we can click here on the very first link, and same thing, read the article, and we'll pick the first one, XAW, and then check it quickly here. Performance did pretty well. Here it did go into the negative a bit by minus 1.74%. Fortunately, you can't avoid this. When the stock market crashed, a lot of stocks and ETFs were affected. This is one of them, but just by a little bit. And again, if you go summary, performance, 5-year, invest at $19 in 2016, now it's 30. So really well. Okay, so now we have XAW. Let's move on to real estate. That's another one that we saw in the initial portfolio. And I typed in best real estate ETFs for 2020. And in this case, I clicked on the balance. I just found this was an easier article to read for people. And scroll down here, best one they recommend is VNQ. And again, we can just go here, VNQ. So real estate, as I was mentioning before, why some portfolio avoided is because it fluctuates a lot. So essentially, in 2016, you bought them at $81. Now they're $84. So you're not making much money. Where you do make money from real estate ETFs is the yield. See, the yield is much higher. So 3.5%, people who have large amounts of money invested, they make quite a bit of money. And then in performance, I'm expecting some fluctuations, and here they are. In the stock market crash in 2008, you will see this portfolio crashed quite hard. So, but since then, from 2009 to now, you made a lot of money if you held this. Okay. All right. So next in line, we've done the REITs, and to finish off, we're gonna pick up some bonds. So I typed in best bond ETFs for 2020, and then once again, we're gonna click on the very first link, and I'm just gonna pick 2, ZAG and VAB. Okay, so to finish up this video and show you that this portfolio, I said it was gonna make between $10,000 and make up to $16,000 in 5 years, right? So let me show you with real-time data how that's possible. And what I have here, let me just move this a bit. What I have here is a website called portfoliovisualizer.com. It's free to use. And what you can do is you can put in all the stocks that you've chosen or your portfolios, and it will show you the performance of this portfolio based on real data on how the markets moved since whatever time frame you selected. So For the time period, I put year to year, start year in 2015. So I said 5-year time frame, and year 2020. Include year to date, yes. Initial amount $10,000. We're gonna play around with this just to show you different varieties. Some people don't have $10,000; they only have 1,000. So $10,000 rebalancing. I said no. What rebalancing is people who put money in ETFs or mutual funds. They don't just dump a sum and just let it there. They just keep adding money to it every single, I don't know, quarter or monthly or twice a year, whenever they feel like it. When you rebalance an ETF like this, your profits increase significantly, because what rebalancing is, let's say you bought a stock at $10 and then the stock drops to $5. If you then go and buy the stock at $5, when it finally recovers back to 10, not only do you break even with your initial investment that you bought it at 10, but you double your money from the second time you bought it at 5. So rebalancing essentially is when you see a dip in the market, like those market crashes, that's the time when you go and buy these ETFs. And there's a lot of investor confidence with these ETFs, because a stock, nobody wants to buy a company that's crashed to the bottom. You're very scared. You're like, they're not going to come back. There's no way. But an ETF has 500 plus companies. These always recover. It's only a matter of time. So if you have money sitting around that you don't need to live off of it day to day, always rebalance when the stock market crashes, or when you see that particular ETF goes down by 5% or whatnot, buy more of it. So I'm going to do no rebalancing. So this is the worst case scenario, where you just let the money sit and just put no, and here portfolio name. So it doesn't matter what name you use. I picked 3 portfolios to demonstrate to you here. One is a balanced portfolio between equity and bonds. The second one, the first one I put equity balances, and it has equity, bonds, international companies, and real estate. That has everything. The second one is mostly equity and bonds 50-50, and the third is just equity heavy. So this is just stocks, no bonds. Okay. And here are the ticker symbols of the companies that we've analyzed before. So XUU, this was the iShares S&P 500. The second one is the BMO S&P 500. This is in the US market. And then here we have our, I believe this is the international markets one. This is a global all cap, real estate, bonds, and bonds. And here I've broken down the portfolios in for like different distributions. So I put 50% of the portfolio is basically in these S&P 500, and then with 20% in the international, 10% in REITs, and bonds 10 and 10. So only 20% of this portfolio has bonds. In the next one, the bonds make up 40% of the portfolio, so it's 50-50. And then last one, I put no bonds whatsoever. It's purely just the stock market, Canadian, US, international, and real estate. Okay, so let's see. You just go down here and click Analyze Portfolio. Let's see what happens to this portfolio if we started investing $10,000 in January 2016. Okay, so our $10,000 for the first portfolio went up to $15,000 by July 2020. Okay. The second one, the equity bonds 50-50, was 14,000. That's the least gain, because again, bonds don't move much. You're making money of dividends, but that's for people who usually create retirement portfolios. They want to be ultra safe, so they're not as aggressive. So the gains are much less, but they're a bit safer. And then the most aggressive portfolio, the equity heavy, no bonds, increased the most to 16,352, and you can see it here. So here's a market crash in March of this year when COVID hit, and so the whole market went down. It doesn't matter what you had, bonds, ETFs, mutual funds, everything went down, but then everything recovered. So this is when I was talking about rebalancing. This is the time where you want to go in and purchase more ETFs, as that'll make you a lot more money. And then the annual returns here is in 2016 is about 6% per. Here 10 to 12%, so this is pretty good. 2018, which was another market crash, look at this portfolio. It only went in the negative with the most aggressive portfolio and just 0.12, which is nothing. And then 2019 and bounced all the way to 24%, 2020, 10%. So this is massive gains for just owning ETFs that have basically no risk. So I hope I convinced you with this video that if you invested 10K, if you didn't do any sort of rebalancing, you just left it there in 2015, today you'd be sitting at $16,000. And you can change the numbers here. You can put $1,000. I mean, the ratios will be the same. $1,000 become 1,600 and so on. So if you had 100K, you would have had $160,000 and so on. If you had 1 million, you would have 1.6 million in 5 years. So that's how easy it is to do this, guys. And I strongly recommend, if you have not started investing, open an account next week and get to it. I've put in on my channel, you can see a few videos on how you can start and where you can sign up. Depending where you are, there's multiple platforms. Either your bank has an investment platform, or you can go, if you're in Canada, I believe Wealthsimple is one, in US, Robinhood, and so on. There's lots of different platforms for investing. And yeah, I wish you luck. Again, this is just for educational purposes. So I don't say you should go ahead and buy these particular ETFs. By the way, there's others that have much nicer gains than this, probably like double your initial investment. But these are not too bad in the end. All right, so if you like this video, please, I would appreciate if you can leave a like and subscribe to my channel and leave a comment if you have any questions. It will really help me a lot, and I hope you found a lot of value in this video. Okay, see you in the next one. Bye.